technology, or specifically AI, technically has been around since the 40s. We've been kind of doing that in the financial services for a long time. It just took another leap forward. So if you think AI is fast, what these folks are calculating is infinitely faster. Welcome to How to Retire on Time, a show that answers your questions about all things retirement. My name is Mike Decker. I'm a licensed financial advisor who can even file your taxes. Now, that said, please remember, this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want financial advice, you can contact our team today by going to www.yourwealthanalysis.com. Joining me is David Franson, colleague. David, thanks for being here.
Hello, Mike.
David's going to read your questions, and I will do my best to answer them. Text your questions in right now to 913-363-1234. Again, that's 913-363-1234. Let's begin.
Hey, Mike, is AI better than an advisor at making trades and managing a portfolio?
This is a nice, genuine question because there's been a significant shift in how we operate in the markets, how not necessarily the markets themselves, but how our relationship has now evolved into the markets. Let me see if I can paint a clearer picture, though.
Okay. Tell us what you mean by that.
Our relationship with farming fundamentally changed when the tractor was invented. It was fundamentally changed when we realized how to do monolithic crops and overproduce. It significantly changed when we figured out pesticides. Now, I'm not for or against pesticides. That's not my area of specialties. But do you see how a technology can change our perception, the cost of, and just every aspect of an industry?
Sure, yeah. They probably got more productive on the farms, right, when there were tractors.
More productive, costs were cheaper to the consumer. It was more exciting, whatever you want to call it. Technology, or specifically AI, technically has been around since the 40s. Now, hear me out on that. Okay. What is AI? It's just a computer that is smart and can do calculations for us faster than us on our own. That's it. I know we call them large language models. And look, I've delved deep into the rabbit hole to understand how ChatGPT works, how Grok works, how all these different AI softwares work. But the simplest form is it's really binary experimentation of just learning how to interact with certain situations. We just figured out a way to advance the consumer's ability to get information that they want faster and more comprehensively. But we've been kind of doing that in the financial services for a long time. It just took another leap forward. So hear me out for a second.
How does that manifest itself?
In the 1940s, we first started using computers mostly for military purposes. Okay, do you remember Alan Turing and the Imitation Game?
Yes.
The movie there?
I did see that.
And it basically helped us win the war. We started interpreting using computers. We would figure out the first line of the code, and then we would decipher basically the war and what was going on, the moves. So that was the first step of AI. It's to get a computer to do something faster than we could on our own. Okay. Now, take leaps forwards. When you look at the 50s and 60s, the banking industry and other financial industries started using technology mostly for accounting purposes and just general business. But then in the 70s and 80s, it started advancing towards algorithms. So, for example, you can track certain metrics in the market like a moving average. I'll just use this one. This is the easier one to explain. The moving average, let's say the 200-day moving average, which is a very commonly used indicator. It takes the average price of, let's say, the S&P 500, so SPY or VOO, the average price of that position over the last 200 days, so the ups and downs, what's the average price, and compares it to today's price. And if today's price is higher than the average of the last 200 days, then for most people, it would consider that an uptrend, that the markets are going up. If the average price is below, then it would be considered in a downtrend. And this algorithm, this simple calculation, gives investors an insight into then what would be happening here. Okay, so you with me so far?
I'm with you,
It's just a simple equation that can be done in a blink of an eye.
Okay.
So you've got the 70s and 80s, and Wall Street is investing heavily into computers, into running the algorithms so that they can have basically less staff on hand and react quicker to whatever the markets are doing. Great. Advanced now into the 90s and 2000s, things get a little bit more advanced. You start to see things called high-frequency trading. what is high-frequency trading? High-frequency trading is the shops that are as close to Wall Street as possible that have, I think there's a movie about Hummingbird Project that kind of talked about this a little bit. Anyway, they have basically very advanced computers with direct lines to the trading floors so that when an indicator happens, according to their algorithm, that they can get in faster and leave faster than anyone else. Their trades get in first.
I see.
And it's just because they're there sooner. They have the high frequency is what they call it, or the quicker trade. Why does this matter? Okay. If you're so concerned about getting in first, that you're concerned about the metal of the wiring and the fiber optics of your cable, that you're concerned about these supercomputers and even the metal that's used in the different computers and so on, that's pretty fast. So if you think AI is fast, what these folks are calculating is infinitely faster. The amount of bandwidth and computing power to do high-frequency trading is insane. And then to optimize the code so the code goes faster, we're talking not milliseconds, but like nanoseconds of differences that they obsess over to get that little advantage. Okay.
And so they're constantly been working on this like over the decades, or?
Oh, it's been going on for, decades.
Huh.
This is not a new thing.
Okay.
But many people don't know it exists. So when so anyway, and then you advance to then 2010 and so on, the automations become more common, more prevalent. Computers have advanced for the trading advantage, the algorithm, the model, whatever you want to call it, okay? But notice this has been going on for many, many years. So when people say, well, is AI going to replace financial advisors? My immediate thought is it depends on who is handling the tool.
What everyone wants to know is your job safe, Mike?
Oh, it's if AI took over this industry, I could still find work elsewhere. I don't think it will, but I don't care. I shouldn't say I don't care. I do care, but I'm not concerned about creative destruction.
Oh, yes. You've talked about that before, yeah.
And creative destruction is when your job is replaced by technology. And the reason why I'm not concerned about it is because markets are emotional. You can't just ask ChatGPT to beat the market every single year. Markets are emotional. And also, what's your risk tolerance? What do you want your investments to do for you? There's so much nuance in there that you have to be the controller, not the tool.
Okay.
So, for example, let's say you want to use ChatGPT for your trading, and please don't do this, but let's just say, if that were the case, then you could say, hey, ChatGPT or Grok, write me an investment algorithm that can time the market.
Yeah.
That's, you've overestimated your abilities and ChatGPT's abilities to be able to do something that you don't actually understand. That's like saying, ChatGPT, I want to perform this surgery on someone. Tell me everything I need to know, and I'll just follow those instructions. Okay, so I cut open the, I don't know, what do you call the chest? Yeah. I'll cut open the chest this way, and I'm going to insert these numbing medications or whatever here, and I'll just follow the instructions, and it'll be fine. It's, granted, that's more of a life and death situation. This is finance, not as extreme, but you get the idea.
That only happens in the movies, I think. Emergency surgeries.
Yeah. So the reason why I'm bringing this up is there's something called the Dunning-Kruger effect, and it's going to wreak havoc on a lot of people, in my opinion, in the near future because they are becoming over-reliant on ChatGPT. They're utilizing the tool without enough understanding of the fundamentals of how finance works. Here's an example. There's a couple of stocks that have made many people very, very wealthy. Palantir, NVIDIA, for example. They may do really, really well in the near future. But most people I've met that are invested in those stocks do not understand the risk they're taking for the growth potential that they've experienced. For the last 15 years, we've been treated very well investing in large cap or large companies in growth like with a growth incentive or a growth theme. What does that mean? Whenever the markets crash next, those are the ones that will probably go down the hardest. So let's say that NVIDIA has grown exponentially over the last 2 years, which it has, and you bought in now. are you okay potentially losing 50 or 70% of those assets? Maybe that happens. Maybe it doesn't happen. It happened to Amazon in the 90s and 2000s. Amazon's a great company. It eventually came around, but it took over a decade to come around. If you're retired or near retirement, can you really take that risk?
Yeah, probably someone in their 20s could take that risk readily.
There's an inappropriate feedback loop on this. And so going back to ChatGPT, the psychological phenomenon is called the Dunning-Kruger effect. And that explains why I think people are over dependent on ChatGPT, thinking it can beat out other models. The Dunning-Kruger effect basically assumes or suggests that people who lack experience don't know the right questions to ask. So if you're going to use ChatGPT or any AI to create a model, do you know to look for the Fibonacci retracement? Do you know to look at not just the 200-day moving average, but the 50-day moving averages and how those correlate? Do you know that 60% of the time when the 50-day moving average goes from negative to positive with the 200-day moving average, that roughly speaking, there's a 60% chance that it will actually break out and grow, but there's a 40% chance that it falls off a cliff and keeps going down? Do you know what resistance levels are and the different variations of that? Do you understand the nuance of head and shoulders and the market trends there? I mean, and I'm just touching the tip of the iceberg here of the did you know? Do you know to look for these things? Because if you don't, you could be overestimating, well, ChatGPT said, so it must be right because it quantifies everything. ChatGPT is only as good as the inputs you have. Garbage in, garbage out. So you have to start to question, okay, well, do you want to use ChatGPT for your services or for your trading or whatever it is? If it's an insignificant part of your overall portfolio, why not? Do whatever you want with your money. But if it's everything you depend on, your life savings, I would caution against it. Now, there are services out there, subscriptions that you can enjoy that use ChatGPT, but professionals, people with sufficient experience, have then created and trained ChatGPT or their AI algorithms to do a certain thing. But that's been happening for a long time. We just now have a new name for it. Those services proceed with caution. And here's why I cannot emphasize that enough. I've seen many of them, on X or Facebook or LinkedIn, and they're bragging about how their performance is outstanding and things like that. And for them, I'd say, wonderful. I'm happy that you've been making money. But you don't earn your stripes when the markets keep going up. You earn your stripes when the markets are going down.
Yeah, good point.
And many of them were established after the pandemic. So what they had was it 22 or 23 that the markets, they had some difficulty. It wasn't a market crash. You're not earning your stripes in that kind of a situation. You earn your stripes in a 1987 Black Monday when the markets tank in a very short period of time. You earn your stripes when you're navigating political unrest like in 1990 when Iraq invades Kuwait. You earn your stripes in the 50s and 60s when the markets crash because of interest rates and inflationary issues. You earn your stripes in 2000, 01, and 02 when all the NASDAQ is down 70% and tech stocks, everything that the algorithm said you should buy, were doing horrible. And you had the foresight to diversify in other industries like real estate or in bonds or something else. You earn your stripes in 2008 when you think, generally speaking, the public thought that the banking and financial industry is going to collapse, and you move into the bond market, the largest financial investment market in the world, aside from foreign exchange, that you advance in other areas and you hedge against it because you had the foresight not to get greedy, focusing on growth and forgetting the risk that you're taking, because no risk, no reward. Well, that's a dumb phrase. You're not compensated for the risk you're taking is directly correlated. The risk you're taking is directly correlated with the growth potential. But the more growth potential, the more loss potential you also have. And we have forgotten what that really looks like over the last 15 years because we've been printing money, which makes its way up to large cap stocks. That's why the S&P 500 continually seems to do well. And it'll keep doing that until it doesn't. That's why we've forgotten about how bond funds, as much as I hate them, have a place sometimes in certain portfolios under certain conditions. And do you have the knowledge or foresight to understand those conditions? I'm not saying you need to develop a codependent relationship with an advisor. I'm saying if you want to go down the ChatGPT route or you want to be a DIY investor, you should never stop learning. Always ask the question, what risks am I taking? What's the downside of this? Because there's an even distribution of risk versus growth potential. And the more growth potential, the more downside risk you are taking. There's no way to economically separate it. You cannot time the market as in going in the market and then going to cash. No one can do that consistently. And so you need to understand AI is just a more advanced version of what we've already been doing for decades. There's a story, an actual case study of a college kid that was hired by a large fund. I won't say who. They're out of business. I mean, the SEC destroyed them, spoiler alert. But they hired a very smart, I don't know if it was a PhD candidate or something like that, or a master's in economics, whatever, very smart kid to build an algorithm that would then allow them to maximize returns. A very normal thing. So the kid breaks out Excel. This is, I think, in like 2010 or something like that, if I remember right. Breaks out Excel, figures out an algorithm based on back-tested data, hands it to them, and they implemented it. And their clients lost so much money.
Oh boy.
Because they didn't double-check his work. They didn't stress test it. They didn't look at the different financial environments that he could play under. And, I mean, there's a reason why they're out of business. There's a reason why the SEC got involved. There's a reason why, I don't know if someone went to jail for that, but be very careful about these new investors, new managers with new ideas using ChatGPT to sound smart, but it may not be tested for these different seasons and economic environments.
So it sounds like the pros behind the scenes are using some pieces of algorithms, AI, to further their research or execute trades quickly or what have you. But for the everyday Joe, like you or I or our listeners, we proceed with caution. Is that right?
Proceed with caution. I mean, my day starts at 2:30 in the morning. I'm not up yet, but my day technically starts then because I'm receiving reports from our quote unquote AI algorithms doing the research so that I can take it, move it around when I wake up, and then understand, okay, here's where the market's moving. Here are the shifts. I'm double checking its work. I'm using it as quick research. So we don't need a staff of 20 to do the research. We can have the AI algorithms doing the research based on what we've taught it to do with specific algorithms and specific indicators so that the report can come back so I can see what's going on and then I can make decisions moving forward.
That makes sense.
But it's taken me a decade to really dive into those details to understand that, hey, if interest rates go up or down, here's how it would affect the different models. And based on the political environment, which is an emotional situation, this is some of the risks that you may not be able to calculate in an algorithm. It's more, qualitative, not quantitative. And you've got to marry the two together. So the reason why is I'm not sitting here defending, oh, I'm a financial advisor and you need me. I'm saying proceed with caution because there's a lot of options out there where it's just lipstick on the pig, where it looks really, really good, but you have to question its long-term effectiveness. Is this making sense? Am I explaining this okay and fairly?
I think so. Yeah, I think that it's a deeply sort of nuanced, or there's more than we know about it. Right on the surface, we can just enter these prompts in, and we think that everything that comes back is so amazing and true, right? But it may not be. Just
do research. Go to YouTube and type in the Dunning-Kruger effect.
Yeah.
Even though it's a psychological YouTube video that's been nicknamed why stupid people think they're smart, it's really why uninformed people or people that lack experience overestimate their abilities. Don't work with someone in any capacity. In my opinion, you shouldn't work with someone in any capacity if it's someone that's new and lacking experience. Now, they may be young, but they were mentored by someone with wisdom and experience. I have no problem with that. But the rogue person that decided, I'm just going to cheat Wall Street and beat them out, and did a few prompts in the ChatGPT and then built a nice website, like, just be careful. There are wolves in sheep's clothing. That's the time we've got for today's show. If you enjoyed today's show, then consider telling a friend, leaving a rating, or subscribing to it wherever you get your podcasts. Just search for the show, How to Retire on Time. If you want help with your retirement plan, then give us a call, 913-363-1234. Also, you can just request a free copy of our book. If you want to just start there by going to retireontime.com, you can download your copy today. But on behalf of everyone here at Kedrick Wealth, we want to thank you for spending your time, your most precious asset, with us today. We'll see you in the next episode.